Wouldn't it be a great feat achieved if you knew how to make money in the stock market? Conflicting to popular beliefs, making money in the stock market is not a difficult task. Neither is stock market wealth reserved for few elite investors. There is no doubt that anyone can generate wealth in the stock market provided they do one key thing right, that is to analyze and invest in the right stocks. If you master at this one step, then you will surely make money in the stock market. So, welcome guys, you are watching our channel where we are talking about stocks and investing. We have all played our favorite sports at least once in our lives. For instance, we all play cricket. But does this mean that we can play in the World Cup? Sadly, no. So, what makes us different from professional cricketers? It's the knowledge and the skills they apply to consistently win matches. The stock market is also like this. Skills and knowledge in choosing the right stock is what makes great investors stand out from normal ones. So, when you think about how to make money in stocks or how to make money in the stock market, the answer is fairly simple. You need to master the art of choosing the right stocks. If you master out this at one step, then you will surely make money in the stock market.
Now the big picture arises, how do you pick the right stock? To pick the right stocks, you must conduct thorough research about the company. This is like conducting research before buying your mobile. You would first compare various models, research about the brand and a lot more to decide which mobile is the best. Similarly, when you are researching the right stock to invest in, you must look for these 5 things. Number 1 is to analyze the sector in the industry. We have all heard about the top-down approach, right? If not, then let's quickly understand it. The top-down approach focuses on the broader picture first. So, we first glance over at the performance of the overall economy, then a specific sector, then comes the industry and finally the company. There are various sectors in our economy. Some of the major ones include financial services, information and technology, consumer goods, oil and gas, and pharma. But why should you analyze the sector instead of the company in the first place? This is because understanding the sector in which the company operates helps you understand how the company might perform in the future. When a sector is booming, most of the companies which belong to the sector will also grow. Whereas, even if you invest in any well-known company but the sector has been underperforming, there are high chances that your stock might underperform too. For example, aviation sector is known to be a difficult sector to operate. So, when you think about how could you make money in the stock market, the first thing to look for is the right sector. Next, you need to look for the booming industry in a particular sector. You might be wondering, what is that thing which differentiates between the sector and the industry? Well, the sector refers to the larger segment of the economy. Industries are the structured group of businesses of a particular sector. For example, the financial services sector is diversified into a broad range of businesses such as mutual fund industry, banking businesses, non-banking financial companies, NBFCs, insurance companies and a lot more. So you must look for booming industries from a particular sector.
This brings us to number 2, that is the business model of the company. Once you select a booming sector in an industry, you then need to compare stocks and analyze the business models of different companies. You must choose a company that is constantly improving its technology and adopting innovative practices to improve its potential. Such companies have higher chances of long-term sustainability. So, to select the most promising company, you can simply look for a company's unique selling points, USPs. You can also do a strength, weakness, opportunity and threat SWOT analysis. Number 3 is important overlooked parameter. The management of a company. This is one of the most overlooked areas while analyzing a stock. Investors rarely pay attention to the quality of people who are running the business. This is a huge flaw. Management is the backbone of a successful business. A company's management is in control to provide value to its shareholders. The decisions taken by the management will affect the company and eventually the share price. Hence, you must check the management commentary or management discussion and analysis section in the annual report of the company to know their views about industry and business. Here the management also provides insights into their future goals, opinions, challenges and a lot more. Coming to number 4, that is financial statements of the company. The next important thing to check in a company is their financial statements. This data is readily available to us in the present times. All you need to do is refer the investors section on the company's website. You must check consolidated financial statements and not standalone statements. This way you have a wholesome view of the entire group companies. While studying a company's financial statements, evaluate the following. Balance sheet. This shows the total assets and liabilities of a company. Income statement. This shows aspects such as revenue, expenses, taxes, etc. Cash flow statement. This is a reflection of the cash flow required for day-to-day survival and liquidity of a company. You must also check the annual reports, which describes the important activities undertaken in the financial year.
Lastly, number 5 is financial ratios of the company. This is a shortcut for studying the detailed financial statements of a company. Financial ratios help you analyze and compare key parameters of a company. Here are a few important ratios to consider while selecting the right stock. The first is profitability ratio. Profitability ratio helps you analyze how much profit the company is able to earn on its capital. Profitability ratios include return on equity, which is equal to net income divided by shareholder equity. It measures the ability to generate returns on equity capital. Here, you must compare the average industry ROE with the ROE of the company. Ideally, the company which provides consistency and growth in ROE is the ideal investment option. The next is to consider is return on asset ROA, which is equal to net profit divided by total assets. It measures how potentially the company is using its asset to generate returns. You must look for stocks with high ROA. Higher the ROA, the more efficient the company is. Coming to third, that is return on capital employed, which is equal to the earnings before interest divided by capital. ROAS determines the returns generated on the entire capital, i.e. equity plus debt capital. This brings us to second important ratios. Liquidity ratios. Do you ever go out shopping for purchasing clothes without money? No, right? Similarly, for smooth day-to-day operations, the company must have enough liquidity. Liquidity ratios measure the company's ability to meet its short-term obligations. So what is current ratio? It is simply current asset divided by current liabilities. The current ratio is used to monitor a company's ability to pay its short-term obligations due within 12 months. These payments include interest payable, salaries, wages, etc. Ideally, a current ratio of less than 1 indicates that the company might not be able to meet its short-term obligations and may default. So, always look for a current ratio of more than 1. This is not the case with quick ratio. Quick ratio is about quick asset dividing by current liabilities. Quick ratio measures a company's ability to pay bills due in the next 3 months. It does not consider inventory. This is because inventory can take longer than 3 months to be sold and converted to cash. Now, what about solvency ratios? Solvency ratios compares the debt levels of the company to its assets. While quick ratio measures a company's short-term obligations, solvency ratios measure a company's long-term obligations. The first is to know about debt to equity, the ratio. Debt to equity ratio shows how much debt a company has compared to its equity capital. A company with high debt will have to spend its earnings on repayment of interest and principal. So, equity shareholders might get very little share of a company's earnings.
Interest coverage ratio. Interest coverage ratio measures a company's ability to honor its debt payments. Ideally, the interest coverage ratio should be high, as it denotes that the company has the ability to pay its interest on time. These are some of the most important parameters to consider while finding the right stock. But while you analyze stocks, you must check if the returns generated by the stocks and the risk involved align with your investment goals. If not, then the stock might not be the right one for you. Finding the right stock from more than countless listed stocks is indeed time-consuming. You might have to read numerous books, analyze financial statements, financial ratios and whatnot, but we have an easy way out. If you want to know which stock might be the right fit for you, then we analyze over various data points and find right stock according to your risk profile and time horizon. So, you get to invest in great quality stocks within minutes with just a few clicks. Check the link in the description below to make your first investing. Thanks for watching and subscribe.